Hi guys, my name is Brett Manning. You see me on the site as ChartTrader. I've been trading for close to 2 decades, and I've had a lot of success as a day trader and a swing trader. However, that wasn't always the case. What made a real difference for me was getting disciplined about risk and money management, because this is probably the most important determinant of long-term success for traders. Today, I'd like to quickly go over what I see as perhaps the most important concepts for effectively managing risk and exposure as a short-term trader. The first point I'd like to talk about is gauging stop levels. You know you need to use stops if you're using leverage in your trades. But how do you decide how big to play in a position? Well, the most important thing to do first is to get a sense of the answer to this question. At what price would I feel more confident that I'm wrong rather than right on this trade? This is just like the scientific method and the use of hypotheses in experimentation. Karl Popper called it falsifiability. The idea is the most important thing that makes a hypothesis a good hypothesis is how definitively it can be disproven. You should think of trading setups just the same way. Adopt a style that focuses on opportunities that you understand easily in terms of what it would take to feel that they've failed. For me, that's a matter of the evolution of a pattern on a chart. If you're going to trade with stops, it shouldn't be a fundamental price level, but a technical one. Some people like moving averages or Fibonacci levels, but whatever method you use, this should be your first consideration when appraising the quality of a setup. As a final note here, I've found it's definitely just fine to get stopped out and then get back in the same trade. In fact, in many of my best trades, this is exactly what's happened. The stop is really there to cut off a major loss and to give you a break back outside the position to reassess it. But if a market disproves the setup by hitting your stop and then returns to reinforce the setup, in a sense, it's proving the setup a bit more by disproving the opposite side of the market. In any case, once you know where your stop should be placed, now you can decide how big to trade. So the reason it's important to first understand the type of movement it would take to make you feel like you're wrong about a trading setup is because that's how you know how much size you can trade on the play. I would never recommend risking more than 1 to 2% of your capital on a trade. So once you know how much money you're willing to lose and how far away your stop needs to be, your size on the trade is just a function of those two ideas. For example, if you have a setup where you know your stop needs to be 50 cents away, and you can only afford to give up $1,000 on the trade, then you know you shouldn't get bigger than 2,000 shares. It's just that easy. Finally, it's important to understand what time frame you're trading. There are basically 2 ways to turn a day trade into a swing trade. There's a right way and there's a wrong way. The wrong way is to be unwilling to take the loss. The trade essentially survives in your portfolio because it hasn't acted the way you think it should. This is not a good approach. The right way to turn a day trade into a swing trade is when something performs so much better than you expected that you decide to hold on to it. Basically, it forces you to look at the longer time frame chart and realize that something more important must be going on. In other words, the position survives in your portfolio by earning it. Now, this webinar about risk management for short-term trading is a simple set of ideas. Understand setups in terms of where you're wrong. Understand trading size as a function of max dollar loss limits and location of stop levels. And understand before putting a trade on whether or not it's more than a day trade, and only let it keep going if it earns the chance by acting well. I hope this brief overview has been helpful. Thank you very much for watching.